This is the event that exposed how narratives move faster than policy. It also exposed how investors confuse probability with timing. By the end of this, you will understand why a cut story can work even when cuts do not happen. You will also see why the same story can fail suddenly. But first, let me show you what really triggered this. Welcome to Alpha Markets, where we decode the market. Build your wealth. The 30-day test was simple on paper. Track how SPY behaves when the market starts pricing easier money. Then compare that to what the Fed is actually doing. Going into late 2025, conditions were already strange. The federal funds rate sat in a 3.50 to 3.75% range. That stability sounds boring, but it matters for valuation math. It also matters for corporate planning and debt refinancing schedules. Data shows that stable policy can reduce risk premiums even without cuts. At the same time, the index performance looked calm, but leadership was fractured. SPY was down about 0.6% since early November 2025. Yet the Magnificent 7 equal-weighted ETF called MAGS was down 7% since Halloween. That spread is your first warning sign. A flat index can hide a painful rotation under the surface. Another warning sign came from the bond market. The 10-year Treasury yield was around 4.233% on January 24, 2026. That level is not screaming recession, but it is not easy either. Higher yields keep pressure on long-duration cash flows. That is why high-valuation software struggled after the December CPI print. The shutdown also mattered more than most people admit. A 43-day federal government shutdown in late 2025 created a data gap. That means delayed releases, revisions, and payback effects later. For a Fed that claims to be data-dependent, missing data is not neutral. It creates a fog where narratives fill the space. So what set up the 8% move in my 30-day window? It was the market telling itself a story. The story was that inflation was headed down soon enough. The story was that growth could keep going without a hard landing. And the story was that cuts would arrive on a reasonable horizon. Historically, this has meant investors will pay up for equities before the first cut arrives. Bank of America has said the S&P 500 has largely seen robust returns within a year of the first Fed rate cut. That is not a promise, but it is a pattern. In August 2024, when recession fears spiked, probabilities for a larger cut jumped. That week also showed how fast expectations can move. It reminded investors that the first cut can be an emotional catalyst. But there was a catch in early 2026. The market implied probability of a rate cut at the January 27 to 28 FOMC meeting was only 5%. That is basically the market saying, not yet. So how did a cuts narrative still fuel a rally? Because markets trade the slope, not the snapshot. Investors were not betting on January. They were betting on the direction of travel. The trigger event in this case was not an actual cut. It was the December 2025 CPI and the reaction around it. Inflation held firm enough to block a dovish pivot. Core inflation missed expectations, and the message felt hawkish longer. High-valuation software names sold off, including Salesforce and Adobe. That sell-off helped reset positioning and expectations. Then the second catalyst arrived through politics and trade. Trump tariff announcements in March and April 2025 had already trained investors to fear growth shocks. Analysts warned of recession odds rising and rate cut expectations rising. Citi at Citigroup said Trump was more aggressive on tariffs than markets expected. UBS at UBS warned tariffs could pose large risks to growth. That history stayed in the background like dry tinder. But here is where things get interesting. In the first week of my 30-day test, the market stopped caring about the next meeting. Instead, it started caring about the next cycle. Semiconductors and artificial intelligence beneficiaries caught bids. Software continued to lag because premium multiples were being repriced. The Magnificent Seven valuation reset became visible when MAGS touched its lowest level versus SPY since early September 2025. Day by day, you could see the cascade in sector tape. One day, yields eased a little and cyclicals popped. Another day, a weak bank headline hit financials, while defensives held up. Then a strong semiconductor session pulled the index higher anyway. The numbers tell a different story than the headline SPY chart. It was a narrow but powerful push from specific themes. But here is what most people miss. A cuts narrative can lift SPY even if the Fed holds steady. It happens when investors believe the peak rate is behind them. It also happens when earnings expectations stabilize. Momentum can do the rest. Remember, momentum investing significantly outperformed into mid-2025. That habit does not disappear overnight. Drop a comment. Do you think the next big move comes from rate cuts or from earnings growth? I read every comment. Because the debate matters for positioning, and it matters for risk management. It also reveals whether you are watching the Fed or watching the market. Now let us talk key players and decisions. The Fed is the obvious one, but not the only one. The Fed held the policy range steady and communicated patience. That steadiness supported a base case of a no-landing economy. Bulls argue that steady policy is a feature, not a bug, because it keeps inflation expectations anchored. Bulls also argue that companies can plan capex and hiring with more confidence. Goldman Sachs is one of the loud, bullish voices here. Goldman Sachs has targeted a 12% gain for the S&P 500, citing probable cuts and earnings growth tied to artificial intelligence adoption. An analyst at Goldman Sachs said it is sensible to own SPY in that context. Bulls counter that big tech valuations became the lowest in months, creating better long-term entry points for investors seeking productivity gains. Now, to be fair, bears counter with several sharp points. First, tariffs can hit both growth and margins. Multiple analysts have warned of a worst-case downside of up to 20% for the S&P 500 tied to tariff implementation. RBC at RBC Capital Markets cut its target by 11% to 5,500, driven by a growth scare. Bank of America also revised its year-end target lower to 5,600. Second, bears would argue the Fed is operating in a geopolitical fog. Goldman Sachs at Goldman Sachs has said domestic political investigations and global trade shifts can be as influential as the CPI print. That means policy can become less predictable, not more predictable. Data dependency sounds comforting until the data is late or distorted. Third, the banking sector has shown cracks. JP Morgan Chase shares sank over 4% after missing revenue guidance, and Wells Fargo dropped 4.6%. That matters because banks are a transmission mechanism for monetary policy. If credit tightens, the economy can slow even without higher rates. The risk here is a credit problem masquerading as an inflation story. If this analysis is helping you, hit that like button. It helps more people find this content. And as always, this is educational content, not a recommendation to buy or sell anything. The goal is to map scenarios, not to hand out trades. And this is where it gets really interesting. The aftermath of the 30-day test was not just a higher SPY price. It was a change in what investors rewarded. Semiconductor strength signaled belief in real investment and real demand. Software weakness signaled skepticism about paying premium PE ratio levels without a clear dovish catalyst. The market was not saying all tech is back. It was saying select tech is back. The recovery timeline also looked uneven. SPY could rise while MAGS stayed weak. That is not a contradiction. It is a reminder that index weights, sector mixes, and equal-weighted baskets tell different truths. According to SEC filings, flows into broad index products can stay strong even when investors sell specific crowded names. Passive demand can smooth the surface while active pain continues underneath. So what changed permanently, at least for now? First, investors became more sensitive to tariff headlines. Second, they became more sensitive to bank earnings quality. Third, they became more sensitive to inflation components like shelter lags. Shelter can fall in real time while official data stays sticky. That can keep the Fed on hold longer than expected. But there is one more thing you need to understand. Lessons learned are simple, but not easy. 1. Do not anchor to a single meeting. A 5% cut probability can still coexist with a cuts narrative over months. 2. Watch leadership, not just the index. When MAGS is down 7% while SPY is barely down, dispersion is high. High dispersion creates both opportunity and whipsaw risk. 3. Respect gap risk. Historically, the largest SPY gap downs have averaged around negative 2.2%. That can erase weeks of gains fast. Now, let us shift to what to watch now. And this changes everything for investors. Start with the bond market. If the 10-year yield spikes, long-duration equities can struggle again. Next, watch inflation prints, especially shelter and energy. A sudden energy spike could force a hawkish repricing. Then, watch Washington. Tariff implementation details matter more than slogans. Lastly, watch banks and credit spreads. If financial stress broadens, the no-landing story gets challenged. Could this happen again? Another fast SPY move on a cuts narrative without actual cuts? Yes, but it can also reverse. Bulls argue the base case remains no landing, with inflation slightly above target and growth continuing. Bears counter that tariffs and political fog can turn that into a growth scare quickly. Investors might consider scenario planning and position sizing that assumes volatility, not calm. The Fed cuts narrative shows us that markets can rally on expectations even when policy stays put. Share this with someone who needs to understand Fed cuts and SPY narratives. Drop a comment. Are you bullish or bearish on the Fed cuts story right now? I read every comment. Hit like if this analysis helped and subscribe to Alpha Markets for weekly market breakdowns. Next week, we break down tariff risk scenarios and why they matter for your portfolio.